Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Now let's do something else again, and let's change it up just a tad bit more, and let's say, gosh, we're a really good stock picker. Not only did it just move to 51, the stock just now moved to 52. Now in this instance, on the next point movement, we kind of figured out that the first point movement should be about 50 cents. In the second point movement, will it go up more than 50 cents, go up less than 50 cents, or will it go up the same? And I want you to think about that one too. I'm going to give you a little bit of a pause. So we just saw how much it should move off of a 1-point movement. Now let's think about what it should move if the stock makes another point movement. And in this instance, the answer is that it should go to about 410. And I hit one too far, okay? And should go to about 410. And let me tell you this. This is the reason why we like to buy options. Not only when you go out and buy options and you're correct on your forecast, now that's a very big caveat, do you get a lot of leverage in that the underlying is going to move a percentage of the stock price movement, but not only does that happen, as it gets deeper and deeper in the money, you get more and more of that movement. Now the bottom line is, if you think about delta, what's the biggest delta it could ever be? Well, the biggest that it could ever be is 1. And a lot of times I get people that'll answer this first question and say, well, stock goes from 50 to 51, my option's going to go up $2. Well, if you think of that logically, it doesn't make sense in that a delta is derived, or an option is derived from the stock's price. So if the stock goes up 1, you should never get more from the derivative than you would from actually buying the underlying stock. So in theory, the biggest movement you can ever get on delta would be $1. Now, I'm going to talk about, we talked about this brief introduction. Now, I want to talk about why delta changed. And this definition you don't see very often in textbooks, and there's for good reason. I mean, delta isn't really a probability calculation. Once I give you the definition, you'll understand that term just a little bit more. But bottom line is, when you look at options, there's a quick and dirty way that you can get a good feel for what the delta should be. And if we look at this next definition, the non-textbook definition, that you really don't see this in textbooks that often at all, is delta is the probability of the option being in the money on expiration. Now, if there's one thing I want you to grasp today, and out of all the presentation, it's kind of understanding this definition, because delta is one of the most important Greeks. And just understand that this is a proxy for the definition, but it does give you a really good feel for what delta should be. When the stock was at 50 and the strike was 50, when we first started this, the underlying option contract was trading with a delta of 50, the at-the-money option. Why? Well, if you think of the second definition, delta is the probability of the option being in the money on expiration. If you think of that definition, then you can kind of say, well, the stock's at 50, the strike is 50. If it goes up 1, it's in the money. If it goes down 1, it's out of money. Now, also I want to add one caveat. It's probability of it being 1 cent in the money, of just remaining in the money, not being completely like $1 or 2 in the money, just 1 cent. So when the stock's at 50 and the strike is 50, what's the probability of it happening? It's around 50-50. So the delta in the first point movement was 50. Now when the stock went to 52, now what's the delta? Well, in this instance, now you're 2 points in the money. Well, what does that do to the probability? It increases it, right? So now when the stock's at 51 after the 1-point movement, we would expect delta to increase, because now the probability of it finishing 1 cent in the money has definitely had to increase now that we're further in the money. Excuse me. So bottom line is the delta increased, and it was dynamic, and in the next point movement we actually got the delta to move, or the option contract to move to 410 in that instance. So we started off with a delta of 50, And the option reflected that when the stock went from 50 to 51, and it went from $3 to $3.50. And then when the stock went from 51 to 52, the option contract actually went from $3.50 to about $4.10, or it moved about 60 cents on that contract. All right. So thinking of delta as a probability, it will always give you a feel for what the delta should be on your option contract. Bottom line is options that are fairly close to the strike, stock 50, strike 50, or what we'd reference as at-the-money options, you'll usually have deltas closer to 50. As you get deeper and deeper in the money, deltas will slowly approach 1, not get larger than 1. And as you get further and further out of the money, deltas will approach 0, obviously not going below 0. But bottom line is different options will react differently to movements in the stock. And understanding delta helps you understand this type of price movement. All right. So I want to take this one step further. We obviously know that as the stock goes in and out of the money now, that delta will move and will change accordingly. But a lot of times you don't think about what happens as expiration approaches. So let's go out and be really crazy here. Let's look at think of the non-textbook definition of delta, and I'll ask a question again. Now, once again, I want you guys to play along at home, and the question is, if the stock is at 50 and the strike is 50, and you have 1 day remaining to expiration, I have a 1-day option contract that's at the money. Think about the probability definition, and now think to yourself, what is the delta of this option contract? All right, I'm going to take a little drink of water here because I got a little bit of a cold, but what is the delta of this option contract? Think about that for a second. Well, the answer is that the delta is 50. You can't get more 50 delta than this. The stock is right at the strike, and you have 1 day remaining. If it ticks up, it finishes in. If it ticks down, it's going to finish out. So you can't get a more 50-50 delta than with 1 day remaining and the stock and the strike right at 50. Now, if we go up further in time, and we go back to our 60-day example, excuse me again, and we go back to our 60-day example, you will also notice that the delta was close to about 50. But bottom line is really on a call option, and I'm not going to address this too heavily, but on a call option, this delta would really be closer to about 53, 54. And that has to deal with carry issues, and we can talk about that a little bit later. But bottom line is just for sake, let's pretend the delta is going to be somewhere around 50. Now, this is where the probability definition really comes into play and really helps you try to think about delta in a different way and estimate deltas on different option contracts. Now, if I go and let's move the stock now. Let's take it from 50 and move the stock to 51. All right? So now we got the stock trading at 51. The 50 strike call has a delta of 50 for sure on the 1 day option contract. But now think, the stock just made, once again, we're a great stock picker, and it just made a $1 move. In that instance, what just happened to the delta of both my options? What should they have done? If you said they should go up, well, then you are correct. Then the next question is a little bit trickier. By how much? Well, if we look at the 1 day option contract, it actually goes up to about 90. And we look at the 60-day option contract, we already know from our previous example that it goes up to about 60. Now, the reason why there's such a huge discrepancy, if you think about this, with 1 day remaining and the stock's trading at 51, what's the probability of it finishing 1 cent in the money now? Very high, relative, unless the stock is extremely volatile. In general, if you're 1 point in the money with 1 day remaining, the probability of it finishing 1 cent in the money is fairly high. And in this instance, it would be somewhere right around 90, and hence that would get reflected in the delta.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.